This is a comprehensive training guide for microfinance professionals everywhere, all over the world. And I advise you, stick around because you're going to learn so much. Now your microfinance bank that is failing, I can guarantee you, this is the blueprint to make it work well. My name is Eri Ostorima, and welcome to Talking Finance Lecture Series. Why the lending business is failing and how you can make it profitable. Welcome to the Talking Finance Lecture Series. What you'll be learning today, you'll be learning the anatomy of learning business failures. What I'm about to say is you need to understand the root cause that destroys lending business. For inadequate risk assessment to a working framework, then we'll also be discussing world-class studies, as in what went wrong, what drives, what fueled the problem, the escalation of your loans going bad. We want to look at the 5 critical pillars of lending sources. We pay the 5 C's, which have expanded beyond the 5 C's, going to the 7 C's and the 9 C's. Now we're going to be building a profitable microfinance operation. We're not just here to tell you the problem. We're not just here to tell you how you're failing. Remember, we are here to also teach you how to build a profitable microfinance operations. The first, like I said, let's deal with the first thing we need to deal with, which is the anatomy of lending business failures. Understanding the root cause that destroy lending business and how to avoid them. These mistakes are things we do over and over again, and we are not willing to change. We don't do the same thing all over and you're expecting is to see a different result. It doesn't work that way. Okay? So we need to understand the root cause that destroy the lending business and how to avoid them. We'll be looking at the 5 fatal fails that destroy lending business. Okay? In order to look at that, first of all, let me take a cue of this story from the defunct Integrated Microfinance Bank in Nigeria. The collapse of Integrated Microfinance Bank in Nigeria began in 2029 to 2010. This was a significant event in the country's microfinance sector, driven by a combination of liquid crisis, poor corporate governance, TGL from wider banking sector crisis. Okay, the key details regarding the collapse includes initial success and rapid growth. In the year 2006, IMFB, named as Integrated Microfinance Bank, growth was just growing. It was doing well. It became a leading and award-winning, highly regarded microfinance institution in Nigeria. It was at one time accorded the best microfinance bank in Nigeria. Then the collapse came, caused by liquid crisis. The funds were not there to service depositors' requests. They had contagion from corresponding banks. And this was actually caused by one of the failures of the very commercial banks. Then I think Asian and Italian continent, they have problems because Integrated Microfinance Bank depended much on Oceanic Bank and Oceanic Bank. And these were the 2 banks that had problem there. So they had contagion of problem for their corresponding banks who gave them illiquidity problem. They had problem squabbles. It was back and forth with the board members. They were at each other's throat and P was bad. They would have malignant misconduct. At one point in time, everybody was doing as it pleased. With all this problem on ground, there was a regulatory intervention by the Central Bank of Nigeria. The bank was investigated by the CBN, which led to its final closure. There have labor actions on the directors for mismanagement, embezzlement, fraud, and all kinds of things. Now, listing all this is going to give you an insight to the 5 fatal fails that destroyed the microfinance businesses. Now, I'm only talking about Integrated Microfinance Bank because I'm in Nigeria. I knew what happened. I knew when the problem were on. The news were everywhere. But we have to learn. You also have tons and tons of microfinance banks that I've not mentioned here that the CBN have closed. At a certain stage, we had 167 or 168. At a certain stage, we had 887. We keep having numbers of microfinance banks that have been liquidated and closed down. It's never going to end. We only have to go to a microfinance bank. Then when we get to lending institution, you see how bad the result is. We have a lot of them closing without even you knowing what happened because of mismanagement and because of a lot of things. For a microfinance bank and microfinance institution, I will be explaining that in future lectures. But right now, I'm only focusing on why lending business fail, be it a microfinance bank, be it a lending business, because they all have the same problem. Number one, inadequate risk assessment. Poor credit underwriting leads to approval of high-risk borrowers without proper verification. This is one big problem that is recurrent. In my book, The Functional Microfinance Bank, I wrote about pressure target. What pressure target makes you do is it makes you disburse loan that you ordinarily disburse. Is that how you are disbursing overinflated disbursing to the inflated contract, or just from the age you are not supposed to fund because of pressure target, because you wanted to meet target. And because of this, you don't look at risk element. You don't care if the customer is risk prone. You don't care about the risk appetite. You don't want to understand the type of risk, either financial risk or operational risk. We are not concerned about the reputation. We are not concerned about organization. We are not concerned about anything that has to do with risk. And this is one big problem that destroys the lending business. Then another thing we'll be looking at is regulatory non-compliance. For a microfinance bank, it's being regulated by the central bank. For a lending institution, it's being regulated by the state government, which is normally under a purview of a set of governments. Now, for Nigeria, using that as a case study, lending institutions are being managed by the states, the state government, the state Ministry of Interior. In some states, it's just at the courts. But most of the most popular states, most of the states that are more commercial in terms of activities, like Lagos and Abuja, will have their Ministry of Interior involved in the regulatory process. Now, while the microfinance bank put regulatory policies in place for the lending institution, for the microfinance institution, not a microfinance bank, it is not so, which makes it more of a laissez-faire operations. When they come to the operations, they decide where to be, they decide the rate, they decide the interest, they decide the terms. There's no interest rate ceiling. There's a lot of compliance gap that is not being met for the lending institution, which gives them a gap. My cue on this is borrow compliance for microfinance bank. You don't have to be regulated before you think of how to regulate yourself. This makes you better off. Okay? Now, the topic we're going to be talking about is liquidity management. Asset liability mismatch and insufficient capital reserves create variable market shocks. This is very key. A lot of companies now, they employ web managers. What web managers will do for them is the inflow and the outflow. The money is coming from where is it going to go? How can we make big yield out of what we have? So if you understand debt management, you know how important it is for your institution. So one thing you need to take off out of this series is that liquidity management is key. Let's take a look at the fourth one, which is operational insufficiency. Manual process and legacy system increases costs and slows down decision making. When we are slow to make decisions, we are slow to approve, we are slow to understand that there's changes in market trends. The force of demand and supply is not like you don't disburse all your loans in one bucket, in one field, in one portfolio. They go to a market and you see that they are all selling meat there, and they decide to give their loans to all meat sellers. What if the government decides to relocate the abattoir? What happens? That's bad business for you. We need to learn to match asset and liability durations carefully. It's very, very key. It's not just a one square fits, one point fits one pen. It doesn't work that way. You need to get it accurately and accurately clear. Okay? You need to have a stress test for rapid rate change. Conduct a stress test of your business. See what happens if they pull out all the business friends and put in a bucket. At that point in time, if it happens, what you have had to do is to know how to make good and accurate decision when it eventually happens. Okay? Then we need to know how to maintain adequate utility buffers. If you are going to be disbursing loan to a customer, you don't just disburse loan using the disbursable household income. A disbursable household income is what your client that you want to disburse later is having at the tail end of conducting your assessment. In your assessment, we are able to get all his income, all his revenue, deducted his tax, deducted all his loans, and we have all the final budgeting put in any place. The final value that your customer is having after you deducted all the deductibles is your customer's monthly disposable income. Now, in that disposable income, we can normally it could not be more than 30, 40, while for SMEs, we go as far as 50, 75%. We match that disposable income with, let's say, a percentage, the university is 30. And say 30% of this disposable income is what we want the customers to pay his loan for, which means the remaining 70% is will keep him to himself for unforeseen circumstances and for contingencies. They borrow money for 3 reasons: speculative, transaction, and operational. So let's say this customer, he needs money for unforeseen circumstances. Where do you want him to get that money from? And if he says he was going to pay you at the end of his whole monthly disposable income, it's not likely to be possible because definitely things will happen that will make him to pay you. So when you create risk buffers, it helps you to know what you can disburse to your customer. The value of the risk buffer that you get, they multiply that the number of money that the customer wants to collect the loan, then we disburse loan to the customer. That is the best way. We don't ever disburse to a customer that is ordinarily not supposed to take, but that we're supposed to take. Okay? And the final lesson I'll be given to lender is you need to monitor your digital assets, your portfolio assets, and you need to learn how to manage your crisis communication. Customers have one thing at the back of their mind that they don't tell at the initial stage. They can put you in trouble and they can make a mess out of your business. Now let's look at default rates that we are currently experiencing in the microfinance or the banking sector, which has made a lot of things very wrong. Okay, now I'm going to give you this number. It's from the statistics that I was able to look at. We have between 25 in all the loans generally, between 2025 to 2029. The default rate was 36%. I'm telling you from table of analysis that I was able to analyze and I was able to reconfirm. Currently, default rate is as high as 94% because borrowers failed to pay their loans. Now the question is, what went wrong? I'm going to tell you what went wrong. Number one is inadequate income verification. Just like I mentioned in the disbursement and not disbursable income that you are using to calculate what the customer can get. It's very, very rare for you to do that. And if that's something you have been doing, you need to calculate your steps. So inadequate income verification, we don't know how much comes into this business. But the use is either let's guess or let's just do the loan because we need to do the loan because of pressure targets, which puts us in trouble. Another thing is poor risk-based pricing. Okay, we have high risk barriers. Some of that inappropriate loan rates. We get firms where you're not supposed to get at high rate, and you did it at that rate you are not supposed to do it. Even when you did it at that right rate, when they are not coming back, it becomes a problem. Okay? Another thought I'll be talking about is lenders' education cap. A lender's education cap is a big problem. Customers don't understand what you are communicating to them at the first point of their loan. All what they understand at that first point is, I want this loan. I want this loan. Whatever it is we are calling it. If you call it credit, they don't care. If you call it loan, they don't care. If you call it finance, they don't care. All they want is money. This term means different things. But all they want is just money. So at this point in time, Before we start disbursing your loan, I will implore you to educate the customers. This is very key. Once your customers are educated, it makes it easy for you that they understand what you are selling. Let me take Ghana for an instance as my case study. Ghana operated a lot of unregulated NFIs, which led then the collapse of the lending institution in wide-scale area until presently when they've done something about it. What happened? MFIs operated without license. They failed to meet minimum capital requirements and they lacked regulatory compliance. Some institutions expanded too rapidly, opening branches without adequate funding. They were just here, the compliance was zero, many institutions were unlicensed, and the collapse rate was high. Now, let me give you an example also in Andhra Pradesh in India. This one is the human tragedy of what lay was not supposed to be. What was the problem? NFI focused lay on poor borrowers without a certain repayment availability, repayment capability, repayment ability. 70% of borrowers need to understand lane terms. Multiple borrowing became rampant. They were loans upon loans. They call it restructuring. They collected one, they are not true, they are adding more to it. That's why you should know when to refinance and when to restructure. Those two things are key. So what the problem in Andhra Pradesh? MFI forced loan on a lot of people, which became a problem. The causes were on unethical collection practices. They have started committing suicide. It's crazy. 70% of these customers are unaware of the loan terms. 10% monthly interest in most of their loans, which was crazy. And the annual rate of this was up to 20%. If let me jump to the 5 pillars of lending success. The frameworks are just the 5 C's. We call it the 5 C's of lending. We've heard it, and you've heard it all over again, but I can tell you, you don't understand it. The foundation of every successful credit decision making must start with the 5 C's of credit. Now, the very first, like I said, is the character. Credit is and payment behavior. This is what you are going to be checking in the character. It is very, very difficult to check the character of the customer. They will come pretending, they will come telling you they know it, or they will come with emotional blackmail because they need the money and you end up disbursing. But the true character lies and begins to show. They're going to exhibit it when it's time for repayment. The key payment for now that we can use to measure a customer's character is payment history, credit score, reference, past default. Those are the basic things you are going to use. Number 2, let's talk about capacity. This is the ability to repay the debt. Or you can only get the capacity by measuring, by conducting adequate assessment based on the employment history, the debt to income ratio of the customer. That's the place you're going to get the capacity. If you measure the debt equal to the income ratio, then you should know what's the capacity. After the customer has made some revenue at the end of the month, and you pull out all expenses, and you are getting the customer's income base, then you should be talking about, okay, this is his repayment capacity. So the key metrics for this is ratio, income verification, employment stability. Okay, now let's look at capital. Capital looks at the borrower's financial commitment. What do you have? Personal investment, educates skin in the game and cushion losses. Now, what am I trying to say? What do you have to start the business? Anything you put into the business at the initial stage is your capital. So this is very, very key. You need to know what you have. You need to know what you are putting in business. You need to know what the investment is. Okay? Let's look at the fourth one, which is collateral. Collateral looks at the security asset. Assets placed to recover funds. If bearers default, must the value be liquidated? How will it be liquidated? Value be liquidated? These are the things we need to understand how collateral work. And we do give mail based on collateral. It depends on what policies, what business number you are trying to run. Your loan could be collateralized lending or non-collateralized lending. But if it's not collateralized, what you should be looking at what you can fall back on in case the customer does not pay. Now let's look at the final one of the 5 C's, which is condition. You need to be looking at the loan purpose and external factors that may affect the customer not paying the loan where it ought to be. Before we disburse your loan, you should understand the social factor, the environmental factor. If I say social factor, political factor, understand pest and pestle forces. The political, environmental, social, technological. And if it goes to the person, you're looking at the legal, or you're looking at the environmental factors that may hinder you from getting their names. Now, while the general 5 C's is well known generally, there are other C's that hamper and that makes business, that make your lending business fall out of progress. The 6th of it is cash flow. Now, in these cases, accountants has conducted this assessment and decided to let this name scale through, one, because of pressure target, and for areas that they are supposed to scale through, probably they had to fall out with the customer, character, or things that are not favorable to them. So they have a way to play in this situation. Any mistake that has been made as of this position becomes a big problem. Okay, now let's look at other conditions. Now, these other conditions are as a result of the account officer's willingness either to grant loan or block their loans. For a loan officer that accepts gratification or that is expecting gratification, if the gratification does not come, he decides not to let that loan fly. If the gratification is not go, there are a lot of cases, I've seen a lot of instances that in case of that customer, we can give him this name, but I just don't like him. Other conditions could be from the top management. I just have a hunch. I don't feel like disbursing his loans. Others could be a hunch. He's not the address. I don't like the nature of his business. Things could be a factor. So remember I said, what makes the 7 C's is cash flow and other commissions. Now let's go to the 9 C's, which is a critical point that kills lending business. Number 1 is conciliation. In such times, it's much pressure from either the board or the management team that causes this. Let's say you have a target of 50 million in a month, you only done 10. But the answer you'll be taking is, this loan I'm not supposed to do because it doesn't pass through our credit checks. But because we need to disburse loan, we need to meet our target, our full target this month, that we do, we just have to disburse it. We are making consideration that are not supposed to be. When you make this kind of consideration, you make it worse. What I expect you to do in these times of situation is really for you to diversify. Diversification makes you expand your business and tap into other markets instead of relying on just one customer to consider to give loan to that customer. Now let's look at the final end of the 9 C's, which is connections. I've seen situations where loans are disbursed even when a customer just filled a one-page form and other criteria are not considered. The capacity is not checked, the condition is not being considered, the capital is not adequate, no adequate collateral, and as much as 10 million is being disbursed. I'm telling you this live, it happens. So connections is one of the biggest problems we have in this market that will always crumble your main system, that will crumble your lending system. Okay, now I've dived a little much about the problems you face in your microfinance institution. Let's look about building profitable microfinance operation. Number 1, we need to understand that we need to put in key strategies for sustainable profitability while maintaining social mission. That is again, you need key strategies for sustainable profitability while maintaining what? Social mission. Number 1, you need to have a robust underwriting. 1, how do you do that? You establish clear approval hierarchies. No, loan doesn't start and end with the person. It must pass through stages. It must be layered. You must have a risk department that understands the risk element in such loan. Put technology in place. To date, a lot of lending institutions are still collecting their recoveries by cash. If you are still doing that, then you are one of the problems you have. You need to automate your main process, automate your decision process, automate human error, speed up approvals, scale operation, and automate the recovery process. You need to have adequate reserves. This is the 3rd one. adequate reserve at all times in case you are short of funds, in case we are becoming illiquidity. Well, the money fund, that's why you need to have a corresponding bank. The law of OG process with new generation banks now you can relate to. All they just want you to do is to maintain a credit line in them, and I can tell you anytime you need resources, they are at your beck and call. Okay? Another thing you need to learn to do, don't forget, we are looking at building a profitable microfinance operation. I've told you all the problems you are likely to encounter. It only be good if I didn't tell you how to manage them. Build a diversified portfolio. Don't nail your heads in one basket. It's always dangerous to do that. I did make mention of that a little bit. Then we need to have proactive delinquency management process. How do you manage delinquency? First of all, you need to prevent defaults. Just prevent them from happening rather than saying then they happen. Be a proactive person. Be a proactive risk manager. Prevent it, because once you prevent it, it doesn't happen. If eventually it happens, then you know that you have contingencies in place to manage when it does happen. Okay, so make sure there's regular reminders for your customers. The repayments are flexible and early enough so that you cushion a lot of liquidity problems that may come in. Always make sure you are fully compliant. Just because you are a lending institution, that means we should not borrow the portfolio agent bucket to manage your loan portfolio. Don't let loans going by. Don't say I'm not a microfinance bank. Right now, if I'm a microfinance bank, I'll be worried about PAR. That is, you both share the same problem. Either a lending institution, either a microfinance bank or microfinance institution. These are key things that we really need to look at so that you scale wider in your lending business. Success in lending requires balancing profitability with purpose. You need to embrace technology while maintaining human connection and never compromise on risk management. The failures you've studied are lessons, not roadblocks. This is one thing you need to know. You need to apply these principles, but you continuous learning and building a learning business that creates lasting value for both your institution and the communities we serve. Subscribe to our other editions of Microfinance Arena under where they're discussing talking finance. There's a lot to discuss in the financial subset. This is the microfinance and the lending space. We have so much to learn. As you can see, I just did do the same thing.